Welcome back to Money Talks, Yusuf. Now, oil prices have seen their sharpest drop since June. So has the war premium completely evaporated then?
Hello again. I'm always happy to speak to TRT. Well, the geopolitical risk premium was kind of well observed over the past week. Of course, the threats coming from the United States on the situation in Iran has certainly contributed to that. But I believe also what has actually pressured prices towards the end of last year and beginning of this year was the glut story. There's been so much concern about the oversupply coming from, in fact, OPEC and many other producers over the and possibility of buildup of stocks. But I believe now we're seeing also the fundamentals also actually well observed in the markets, because you see prices now trading nearly $65 for Brent. And I think that moving from now on, I believe we should also see prices continue to be resilient, supported by fundamentals rather than geopolitics.
Right. Now that the strike threat from the US has cooled, but with 3 million barrels a day still at stake, is Iran's supply actually safe at this point?
Iran actually doesn't produce 3 million barrels. That's almost the production before the sanctions. Its production is around 2 million barrels. About 1 million barrel is exported, almost all to China, and the other 1 million barrel is consumed locally. Yet, Iran was managing export, despite the sanctions, it managed exporting production to China, and that enabled it to bypass the severe sanctions that were imposed since the Trump administration. Of course, also the Biden administration had a blind eye on Iranian exports, but now it's coming back severe again under the Trump administration. So, but anyway, if we had seen the geopolitical situation escalating due to U.S. military strikes on Iran and complete disruption of this supply, certainly we would have seen a situation where perhaps we need more supply coming to the markets, especially to China. But I think currently it looks like the region cannot stand any further volatility in the situation. Of course, we see GCC countries and other Middle Eastern countries playing an important diplomacy role here with the United States, trying to de-escalate the situation. And I think the possibility that now we're seeing Iran production completely being disrupted is perhaps something off the map.
Right, and with other geopolitical risks still in the picture, Venezuela for one, and disruptions in the Black Sea, yet prices are still fairly muted. Is the market undermining these supply shocks?
Well, as I said, currently fundamentals continue to play the most important role here. And especially here, it's about OPEC plus members. Perhaps the disruption that we have seen in the Black Sea, and even in fact, Venezuela is a bearish story, because we could see ramping supplies from Venezuela to the U.S. And I think here, how the OPEC plus decision will play out in this year is so important. Also, let's also not disregard that the Fed, because this year the Fed possibility of having reduced rates and in fact rate cuts this year by 3 cuts or more, this is highly possible. And look at the index of the dollar. In fact, even the political story around the Fed chair and the shock to the credibility of the Fed has also affected the index of the dollar. This is a very important factor. This is now also supporting prices going up for crude. So I think here we need to first apply the fundamentals, look at what the Fed or the rate cuts from the Fed coming up this year. Perhaps the geopolitics here premium will have a less important role from now, I believe, until the end of Q2.
Yusuf Al-Shamari, President of the London College of Energy Economics, thank you for speaking to us on Money Talks.